Good afternoon, everyone. My name's Michael Houghton. I'm a member of the Lucerne Private Wealth team, and on behalf of Lucerne Investment Partners, thank you for joining us. The topic of today's briefing is the case for gold, a topical and important discussion given the prominences it has had in the press and the attention it has received from investors, professional and amateur. Gold as an investment has always been a contentious topic amongst investors, and some of the biggest doubters have recently turned to gold for their investment portfolios. Lucerne has been allocating to gold for 12 months via our Alternative Investments Fund and for investors directly since March. One of the funds we have been allocating to is the VS Partners Resources Gold Fund, which was offered to the VSG network, and as a foundation investor, it is consistent with Lucerne's investment philosophy and has an attractive fee card aligned with performance. Access to a fund like this is one of the benefits that Lucerne clients enjoy. We are fortunate to have the portfolio manager for this fund, Cameron Judd, join us today to explain why gold is an investment that provides opportunities in the current climate. The session will be run as a 30-minute presentation from Cameron with a moderated Q&A to follow. If you have questions, please type them into the chat window and we'll ask Cameron for his responses. I will now pass to David Leeton of the Victor Smorgon Group to introduce Cameron and explain the genesis of the fund. Thank you, David.
Thanks, Michael. Thanks. My name's David Leeton. I'm a founder of the Victor Smorgon Partners. We're here to talk about the Gold Fund. So what is the Gold Fund? It's a concentrated long-short portfolio of 10 to 20 ASX gold stocks. We'll talk to you about why they're ASX. Victor Smorgon Group, I was the CFO for the Victor Smorgon Group for over 15 years now, moved into a new role within the group called Victor Smorgon Partners, which is immobilising and allowing externals to come into to investments that we're looking at. And in that regard, the Victor Smorgon Group actually cornerstoned the fund back in May of this year with $10 million. And we've actually followed up with subsequent investments into the fund since the 14th of May. So as we will go through, you'll see that Cameron, we have active in-house management of over 20 years experience within the resource area. And you'll hear about, from our perspective, we think we bring a unique view to the fund in the regards to the ability to look both as a portfolio manager, a fund manager, as well as an investor. So that's in regards to that. We'll now go through and I'll quickly show you a graph here that's plotted the gold price and our various junctures to get to forming this gold portfolio. So back in 2015, the Victor Smorgon Group identified natural resources as a potential investment category. At that time, natural resources were in decline. No new capital was being invested, and a lot of mines were being closed due to large debt obligations. So as we do at the Victor Smorgon Group, we partnered with experts in their given field, and in this case, it was Arate Capital. Arate Capital was a global focused natural resources and mining private equity group with extensive experience in both industry and operational, and it was headed by Hugh Morgan and Peter Johnson. In late 2017, you can see there on the graph, we then went and bought the Store Gold Mine out of care and maintenance. And then some 12 months later, we were in full production, and we went from 12 employees to now being over 200 employees. At the same time, in 2017, we took a strategic position in a neighbouring junior listed explorer called Nevada Minerals. In 2019, the Victor Smorgon Group, again as part of our asset allocation and our view to gold, took a strategic decision to actually start storing gold from our store gold production. And then at sometime in May, we then identified a gap between the physical gold and then the listed gold stocks in Australia, which then led us to selling $10 million of our gold, physical golds that was held in Perth Mint, and then seeded this, what we're here to talk today about is the Victor Smorgon Partners Gold Fund. So that's a background to the Victor Smorgon Partners. We come from various, so we have operational both, and then we also have technical and listed expertise. So I'm now going to hand over to Cameron. Cameron will give a bit of background to his experience, and he'll also talk about the gold portfolio and the gold category in general. And then we'll end up with some questions and answers at the end of the presentation, as Michael said. So over to you, Cameron.
Thanks, David, and welcome everyone. Just quickly, I'll introduce myself. As Dave said, my name's Cameron Judd. I started off some time ago as an engineer, and from university I joined a company called Fleur Daniel, which is a very large construction, engineering construction place operating the mine. So I spent some time over in Western Australia, doing just that, building, operating, and designing mines over there. From that, I then did some further postgraduate studies in finance, and then transitioned into mining finance, initially with Morgan Stanley there as an equity analyst for a number of years. Then joined a couple of years after that with Wilson HTM, and then in 2015 joined Arate Capital on the private equity side of things. And there, obviously, at Arate, I looked globally for assets in the mining space, looking at their strengths and their weaknesses, their investment opportunities. And as we've mentioned earlier, that led us then to the Stawell Gold Mine, which I'd like to think I was instrumental in the Smorgons buying that, and I think has been a very successful acquisition so far. And then about this time last year, actually, I joined the Smorgons full-time with the mandate to increase the resources exposure, and which has led to this gold fund so far. So on the gold fund, look, the gold fund looks to take advantage of two aspects. Firstly, the belief that the gold price has significant upside from the current level of $1950 an ounce, where we are at the moment. And secondly, the gold equities, which are a leveraged investment and will outperform in a rising gold price environment. And we'll talk about each of those 2 points in the following slides. So of the 250 listed gold companies on the ASX, we we manage a concentrated long-short portfolio of 10 to 20 ASX listed stocks. It is predominantly long. The short exposure is only on an opportunistic basis. We don't have any short positions at the moment. We don't have any leverage. We don't intend to have any leverage in the fund. So it is predominantly a long portfolio only. The portfolio includes companies with operations predominantly in Australia, and that is to minimise the jurisdictional risk. So whilst countries like PNG and Africa are very prospective, they also have increased jurisdictional risk. And particularly as countries' balance sheets are being stretched, the governments are looking for additional revenues. And if history is any guide, it tells us that these governments will then start increasing royalties and even nationalising some of these assets. And that's something we don't want to be exposed to. And hence, we don't have exposure to those areas. We prefer to stay in the tier one here in Australia. The balanced portfolio, it has exposure to the total mine life cycle. So that being the producers, the developers, and the explorers. And the chart on this slide, I think, compares the composition of the ASX Gold Index on the left-hand side there to what we have in the gold fund. And you can see that the ASX Gold Index is heavily concentrated to the gold producers there in the blue. The Smorgon Gold Fund, alternatively, is more balanced with approximately 70% exposure to the producers, the large caps and the mid caps, 20% exposure to the developers shown there in red, and then a 10% exposure to the explorers shown there in green. And because the gold has been in the doldrums for some time, the developers and explorers, they aren't well covered by the sector. And therefore, if you understand the mine life cycle and how to value these companies, I believe that there is significant upside available in that space. And we'll talk about a couple of preferred stocks in the next slide or two. I just also want to touch on what we see as our key advantage here, the Smorgons, in managing this fund. And I think it's an important point to make. As David said, we do operate or own and operate the Stawell Gold Mine. I'm talking to the guys actually at the mine site regularly. So we're getting constant feed from them in regards to data points, such as the supply side constraints. So, for example, industry costs. How is that impacting them, what they're seeing at the coalface? And that's a very important point. The next point, I suppose, is that we do store physical gold at the Perth Mint, and that's outside of this gold fund that we're talking about today. But obviously, we're getting data feed there from the Perth Mint as well, which I think is also another important input into how we then manage this gold fund. And then finally, as Dave mentioned, the Smorgans have cornerstoned this investment. So we are aligned with investors in this fund. And that is definitely the way we manage it, and we'll manage it going forward. Turning to the next slide here, I think gives you just a quick idea of how we construct the portfolio here at the Smorgans, and even some of our preferred investments. And what the chart shows here is the value of the gold investment shown there on the vertical axis versus the typical mine life cycle, which is shown on the horizontal axis. Also overlaid down the bottom there is the 3 different stages that we look at in the typical mine life cycle, and how much of the gold fund is invested in each phase, which I've discussed in the previous slide there. Firstly, looking at the bottom left-hand corner there, the exploration phase. As I said, there's over 250 listed ASX stocks, gold stocks, and predominantly they are explorers. We're not interested in what we call the penny dreadfuls, that early stage there, those that are digging in the ground or drilling into the ground on the geologist's thesis that there might be gold. What we prefer to invest in is those that are they've actually found something. So they're starting to see that value increase there. Where that number 1 star is, there is an indication of where we like to start investing. So those that have actually got something measurable, that they've actually found something, and yet there's still more upside, we think, in the exploration phase. The company that we prefer in this space is a company called allocating. It's got a couple of assets in New South Wales. It does actually have a small operating gold mine, the Topical gold mine in New South Wales, but nearby it's also discovered what they're calling the Boda deposit. Now that looks like it's still early stage. It's only had about 5 drill holes into it, but it looks like a very early stage copper gold porphyry deposit, similar to Newcrest flagship project called the Cadia Ridgeway operation there. And I know that Newcrest is definitely looking over the fence at how Boda is developing and the drill results that are going to be coming out of this deposit in the second half of this year. I think that's a very interesting one. And if it does prove up to be the size of Cadia Ridgeway, well, then there is multiples on where allocating sits at the moment. So just continuing that mine life cycle there, the explorers, so they've actually found something. They then enter the different phase, the next phase, which is the developers phase, of which the fund has about 20% exposure to. Now this chart shows a rather aggressive drop in the value there. I think that's a bit aggressive. I prefer to see it go across, but what it's showing, I think, is the different risks as a developer that these companies are exposed to. Those risks include, financing the project, construction risks, and also obviously processing risks. Now, where that number 2 star there is shown on the chart is where we prefer to start investing in these developers. Those that are de-risked or starting to become de-risked. They're ticking those boxes off. The company that we like in this phase is Red 5, a company in Western Australia. It's got 2 assets. It already has an operating mine producing about 100,000 ounces, but it's also developing the King of the Hills project in Western Australia. Now, I've been there to site late last year, it was, before COVID impacted, and I know the management very well. I speak to them quite regularly. Now, that project, it's expected to start producing 200,000 ounces a year within 2 years, so a very short time frame. So that'll take the group, consolidate all the group's production base to about 300,000 ounces a year from currently where it sits at about 100,000 ounces. Now, companies that typically produce 300,000 ounces a year are valued on the ASX at the moment about 1.5 billion. Red 5 currently valued about 500 million. So you can sort of see very quickly there's a 3 times upside there in Red 5 if they can achieve that development of Red 5, in which we're very confident they will within the next year or 2. As these developers, as they continue and they become producers, where that number 3 star is there. So obviously they're generating gold, they're producing cash flow, and the ability then to grow then relies on M&A or organic growth. The company that we particularly like here of the producers, and obviously, actually I should make point that obviously the key driver here is the gold price, which then dictates obviously the revenue that these producers are generating. The company that we like here, at number 3 stage, the producers, is Northern Star. It started as a 100,000 ounce producer in sort of 2011, but it's made a series of acquisitions since then. It's now producing about 1 million ounces a year. But what I do like about Northern Star over the other larger cap producers such as Evolution or Newcrest is its more recent acquisitions, Pogo in North America, and also the Kalgoorlie Super Pit, which it acquired late last year in a JV with another Australian gold producer called Saracen, a 50-50 JV. They're really only just scratching the surface there at both of those mines as to the growth opportunities there. And I think we're going to see some very exciting news coming out over the next 12 months on both of those assets, which I think will take Northern Star from what are currently 1 million ounces a year, up towards 1.5 million ounces a year, hopefully in the next couple of years. This next slide here just shows you the gold fund's performance since inception versus other Australian investment assets. To date, the fund has had very strong performance, returning 31% and outperforming the Australian Gold Index and also the Australian gold price. But I think that the key takeaway from this chart for me is that it emphasises the benefit of a balanced portfolio with appropriate exposure to the gold miners' life cycle, as we've discussed, the producers, the explorers, and the developers. So just turning from the portfolio to more the actual thematic of the gold, I suppose, and then also so these next couple of slides I'm going to discuss the gold price, why we see significant upside potential in the gold equities. And I think obviously you'd have to have been living under a rock if you had missed the recent performance of the gold price. And of course then the many following discussions in regards to whether we're near the peak. This chart here, which compares the gold bull markets over time compared to the current gold bull market, which is shown there in the red line, which started in August 2018. And I think there you can see very quickly that this gold bull market still has a significant way to go if history is any comparison. And just a simple exercise of comparing the previous bull markets, shows an average duration for the gold bull market of about 4 years and an increase in the US dollar gold price of about 350%. So applying those numbers to the current bull market implies that the gold bull market extending to about August 2022 and a gold price north of $4,000 an ounce. Now, I'm not saying we're going to reach that gold price as it is based on historical analysis, but I prefer to look at the current market and the fundamentals there when I start generating my gold price targets. And we do that exercise here on this next slide. And look, I appreciate there's different understandings of the gold market. But what I will say from the outset is that gold is definitely a very unique asset. Unlike other industrial metals such as copper and zinc, which has a very strong industrial usage, and its price fluctuations can be understood looking at the supply-demand fundamentals. Gold's price movements aren't dictated by the supply-demand fundamentals. Rather, gold is viewed as a financial asset that has a limited supply, which comes into its own during times of market stress. And the primary reason for the gold price performance so far has been the dramatic decline in yields on US treasuries to levels below the expected pace of inflation. I think that's shown there, that chart, the bottom left-hand side. The orange line there is the US inflation expectations, which are currently about 1.6%, versus the nominal yields there on the US 10-year treasury shown in the blue line there. You can see how that has decoupled. And what it does show there, unlike other safe haven assets like bonds or bank deposits, gold doesn't pay any income. And as a result, owning gold means missing out on yields from other assets when interest rates are high. But when real yields are negative, such as what we're currently experiencing, gold's lack of yield and long-term store of value actually becomes its strength. And this is shown on the chart there, the right-hand side there, which shows a very strong correlation between the gold price there in yellow and the real yield of the 10-year treasuries shown in green. And that the real yield, the 10-year treasuries, is known as the TIPS. The US Federal Reserve has indicated recently it will do whatever it takes to achieve a lower employment rate in the US, as well as achieving its inflation target of 2%. And as a result, the Fed has slashed its nominal interest rates to a rate just above zero, and indicated that it doesn't intend increasing that rate till at least 2023 in the best case scenario. And as we saw there on that the previous chart there, inflation expectations have been increasing with a significant amount of money printing that the US Fed is doing at the moment. The current inflation expectations is about 1.6%, still some way short of the Fed's 2% target, and even further behind the long-term inflation expectations of 2.5%. So just a simple exercise, if we assume the strong correlation between the two variables continues, the Fed has told us that the nominal rates will stay lower for longer and inflation expectations increase to 2.5%, then the equation from this correlation shows that the gold price of US $2,500 an ounce is very achievable, approximately 25% increase from where we are now. And that is what our price target is in 2021 here with the Smorgans. And once that's achieved, the way we're looking at it from a funds perspective is that once that gold price is achieved, we'll then obviously review the gold price and what our gold price target is from there. But as you can see on the earlier slide, the gold thesis, we established that back here in 2016, and it was based on unsustainable debt levels, low interest rates, and low economic growth rates globally. And the impact of COVID has been definitely a catalyst that's brought that thesis or has accelerated that thesis. But if we compare the variables that our thesis is based on now to history, when gold prices have peaked previously, there's definitely an argument that gold could go higher than $2,500 an ounce, and that is definitely a point that we will consider when that gold price does achieve that target price of ours. This next slide here, it considers, how do we look at investing in gold? And I suppose there's three ways that you can look at investing in gold. Obviously, physical gold, ETFs, and of course the gold equities. In our view, gold equities is definitely the preferred investment vehicle due to it having increased transparency and liquidity, as well as equities providing operating leverage to a rising gold price. What I mean by that is, for a 10% increase in the gold price, that 10% increase is actually amplified by the gold miners, who have largely a fixed cost base. So you can imagine that operating margin is actually amplified there. A word of warning though, as this chart definitely shows, that Australian gold equities are volatile. However, the chart also shows that investors have been rewarded with higher returns over time for that risk that's taken. Now, this data is based on 20 years, so since 2000 data. So I think it's a good sample space to show that. Another important point about gold is that over time, gold has been uncorrelated to other assets. And this is a very important point in times of market stress, which is what we're in at the moment. So when every other asset class is declining, gold as being uncorrelated tends to rise. And therefore, it's not surprising that data since 2000 shows that a diversified portfolio with a gold exposure of about 5 to 10% has provided higher returns and actually lower volatility than a portfolio with no gold exposure. And this is definitely the approach the Smorgans have taken when considering and establishing their gold investment approach. Now, a question I get often asked is, whether investors have missed the uptick in the gold equities to date. And I think this question is best answered by this chart, which shows the performance since 2000 of gold equities divided by the gold price. So effectively, how have gold equities performed relative to the gold price in Australian dollar terms? The red line on that chart there is just a long-term average of that analysis. What is clear from this chart is that the previous gold bull markets in 2008 and 2011, I've circled those periods in green, gold equities have significantly outperformed the gold price. The current level of gold equities to gold price, shown there on the right-hand side of that the chart there, is still some way below the long-term average line, and still well below levels reached in previous gold bull markets. And of course, the obvious question is then, what will it take for gold equities to start outperforming? And I think what we need to see is the gold price consolidate at these levels, which then gives market analysts confidence to factor this higher gold price into their models. And that will result in obviously higher gold price targets. And then I think the market will follow from that point onwards. So obviously, you've seen the gold price very quickly accelerate. The market analysts are always lacking confidence, I suppose, to factor that into their gold models. But the higher that we're above 1950 and approaching 2000, of course, our gold price at 2,500, we'll see price targets increasing, and of course, then the market follows from that point onwards. What has become very clear from the current reporting season, it's now is a very good time to be a gold miner. They're currently generating very strong cash flow, and the balance sheets are very strong. And I would argue probably starting to look a bit lazy. The cash flow generation by the gold miners is at record levels, and that's shown by this chart here in this slide. The dark blue line is the US dollar gold price against the average unit cost for the industry. For example, the 50th percentile which is the average cost of the sector. It now shows operating margins at these levels, these gold price levels are now at record highs above US $1,000 an ounce. And just to put that into context, what the sector will consider as a small gold miner producing 100,000 ounces a year, if they're operating at the 50th percentile, they're generating in excess of $100 million US dollars per annum in operating cash flow, which is very strong. Now, to date, also, if I look at the balance sheets, the gold miners, they haven't made the same mistakes as in previous gold bull markets when they leveraged their balance sheets through a series of marginal acquisitions to grow their production base. Another clear message coming from the current reporting season is that the miners, they're very focused on protecting their current strong margins, and will do M&A only if their margins are protected. But with that said, I do expect increased M&A in the second half of this year in 2021. I think as the temptation of growth and a supportive market will be hard to resist for many of the gold miners. And in our view, the portfolio is well positioned to take advantage of this increased M&A exposure. This final slide I just wanted to talk about. It just shows the market forecast earnings for the Australian gold sector and the general market over the last 12 months. So this is a forward-looking earnings forecast for the gold sector. But what is clear is that the gold sector is one of the few sectors where earnings are actually increasing during this COVID period. The blue line there being the all ordinaries, the general market, not surprisingly, the earnings forecasts have been declining. Yet we've seen obviously very strong outperformance from the gold sector, and I expect that to continue as we go forward and as the gold price continues to increase. And just finally, looking at catalysts for ongoing gold equity outperformance in the second half of this year and into 2021, I've already discussed the higher gold prices and the M&A activity. Two final catalysts I think are worth mentioning is that we're starting to see the generalist investor seeking exposure to this gold bull market. Something we're only just starting to see, and clear evidence of that was last week. I think many of you may have seen that Warren Buffett, having been very disparaging towards the gold sector in the past, last week made a significant investment in the North American gold producer Barrick. And I think this is a very clear signal that generalist investors are starting to see the outperformance of gold compared to the rest of the market is starting to become hard to ignore, and are looking for that investment exposure. I think that could be the next leg up for the gold market here in Australia. The final catalyst is ongoing exploration success. And obviously with strong cash flow generation and a very supportive market, exploration levels in the sector here in Australia are very high. And I think that also justifies the fund's exposure to exploration going forward. Look, that's probably all I needed to say. I'll pass it back to Michael, and maybe we can open up for some questions. Very happy to take some.
Okay, thank you, Cameron. And yeah, I'm just opening up the questions. If you do have questions, please go to the Q&A section at the bottom of the screen and type them in. Question here, Cameron, is 5 to 10% of a portfolio enough given your presentation data? And by that, I think the question might be related to allocation of an investment portfolio.
Yeah, and look, it is a good question. A question that we get quite often is, you know, how much exposure should I have to gold? And look, each individual investor, I can't speak for them, but the way, at least I can talk for the Smorgans, the way we're approaching it is, look, as I showed on that earlier chart, gold is very volatile. There's no hiding from that fact. You know, we're in a current bull market due to market stress. 5 to 10% allocation, you know, has shown over time to be probably an adequate level. But again, you know, you know, it depends on each individual case, investor's case.
Yeah, and I think if I was to add to that, you know, asset allocation and portfolio construction is something that's always, you know, subject to what's available at the time, and also subject to what markets are doing and how you see things, and probably a, you know, a conversation that's is always alive. It's never something that remains static. So thank you for that. One of the questions I've got for you, Cameron, is not all mines sort of are able to produce at the same cost, you know, and their marginal cost production varies depending on many factors. Is it hard to get visibility on what those factors are and to be able to make, you know, decisions about where you think the profitability will come from?
Yeah, look, the one thing I think that has occurred in the gold space, and Australia is very good at it, there is significant transparency, I think, in the sector. So the companies report on a quarterly basis, and when they report, you know, they're reporting on their operating performance. So we see actually how much gold they're producing, and they give a number of, you know, there's a fairly standard way of reporting. So we get to see how the operations are performing, and then also their cost levels, the unit costs. And from there, you can then back out a number of metrics that I look at to then sort of be able to compare, you know, one operation to another. And as you say, you know, how profitable one is to the other. And you're quite right. You know, no gold mine is the same as another. You know, grade, there are so many different variables, and, you know, one being grade, gold grade actually in the mine, the ore that they're producing. So, you know, there's so many different variables that we need to compare to come up to with our analysis as to how profitable one is going to be over another.
Okay, I've got a few questions coming through. One of them, do any of the producers generate a yield, and if so, can you give an example?
Yeah, and look, that's a very good point, and probably one that I should have touched on in the presentation. And we've seen it recently, and actually there was comment made on Northern Star's presentation last week, which is, you know, the gold yield, gold mining is a very capital intensive industry. So typically it hasn't been a high dividend yield payer. But with obviously the cash flow generation that we've spoken about in the presentation, you know, we're starting to see dividends increasing from the gold miners. So as an example, Northern Star last week, they paid a normal dividend, normal final dividend of 9 cents a share, but then they also paid a special dividend of 10 cents a share. So that was a 160% increase on FY19. That was on the same day that Westpac actually didn't pay a dividend. So, you know, we're starting to see the gold miners, their balance sheets, strong balance sheets, cash generation, they are paying dividends. And, you know, we're starting to see that. And a lot of their dividend policies are actually aligned with the cash flow generation or revenue. So, you know, going forward, I think that we will see, you know, increased dividends going forward.
And probably aligned to that, the next question is, with earnings forecasts up 62%, what gold price and $8 US dollar exchange rate is being used?
Look, I can't speak. I mean, that was the market consensus there, that chart I showed you, and I can't speak for all analysts, but my sense is the consensus gold price at the moment is probably about $1,900 US dollars an ounce, and the exchange rate that most are using is at about 70 cents. So, you know, we've seen gold obviously recently go through 2,000 US dollars an ounce. You've seen also it's quite volatile. It's trading just below 1950 at the moment. But, you know, I think that we will see, as I said, as the gold price consolidates at these levels, you know, analysts will start increasing their gold forecasts with more confidence. and that will result in increased earnings, and then obviously increased price targets, and then the market follows from there.
Yeah. Okay. Thank you. What could the industry average margins be if gold does hit your 2021 target of US $2,500?
Look, it's a good question. And when I look at my experience with the gold miners over time, there is a percentage, and not every, as I said, not every gold miner is the same as every other one, but there is a percentage, roughly about 50 to 6% of the cost base is fixed, and then the remainder is variable. And, those variable costs can obviously include diesel. We know that oil price is very low at the moment. So, if gold price continues and we start to see some inflation, that inflation coming through in the market, I think you will see cost pressures starting to increase. We haven't as yet. The gold miners have done a good job of keeping those costs, a lid on those costs. But if we do see $2,500 an ounce, there will be an increase in costs going forward. But I think still, the gold price increase will well and truly offset that increase in gold cost. And I think those $1,000 gold margins could expand even further.
Okay. Okay, so there's a question here, Northern Star versus Newcrest. Do you see one or the other as being better able to take advantage of the current market?
Yeah, it's a good question. Newcrest, for me, and I can only talk my analysis of Newcrest, is it's, I can't see, and look, it is, for those who don't know, it is the largest gold producer, by far here in the Australian space, producing over 2 million ounces of gold a year. Northern Star, about 1 million ounces a year, and then Evolution, roughly about 900,000 ounces, but increasing to about 1 million ounces in the next couple of years. But so there is, there is a clear difference between Newcrest and then Northern Star and Evolution. But I can't see the growth opportunities at Newcrest. It's not clear to me those growth opportunities for them to increase that 2 million ounces a year beyond the 2 million ounces a year. They've got some very good assets that I think will continue to produce at that 2 million ounces a year, but I just can't see the growth opportunities there at Newcrest. When I compare that to Northern Star, which, as I said earlier, currently producing about 1 million ounces a year, and I think with Pogo and the Kalgoorlie Super Pit, recent acquisitions, once the company starts exploring there, they're going to find a lot more growth opportunities, and I can definitely see Northern Star increasing that production base, towards 1.5 million ounces a year.
Yeah. There is actually a question here that's, I think, very interesting because it's kind of snuck up on us a bit towards the end of last week. It only really got the headlines, which is Clive Palmer's battle with WA. And the question's asking, do you see a risk for gold miners from a royalty or taxing situation that might come out of left field?
Yeah, I think it's an interesting question. I think previously we've definitely seen that with, I think Kevin Rudd's sort of super tax that we saw some time ago. I think we can never say never, but I think here in Australia, we do have a very stable, tier 1 jurisdiction. There hasn't been any discussion about royalties increasing. There is a certain percentage that the government takes each year, and that has been very stable for a long time. I'm not concerned about that, no. I would be if I was in some of those, more riskier jurisdictions such as PNG or Africa, which I discussed in the presentation earlier.
Yeah. Okay. And would the fund ever look to broaden its mandate? The question here is specifically asking other metals, silver, copper, palladium, lithium.
It's a good question. I mean, the gold for us definitely plays into the thesis, our defensive thesis here with the Smorgons. But as I say, we're monitoring that, daily, our thesis. And, we do have, as I've gone through the presentation, some, gates, if you like, or targets that we've got for the fund. But, once we see that playing out, and again, we're aligned with investors. So once we see that playing out, and, we look at IRR perspective, we will then look to close the fund, and we are talking about more growth orientated fund, such as with a copper exposure, something like that, and that is probably something which will come after the gold fund. But maybe David, did you want to talk about that at all?
No, just as the fact that we are looking at various options, and that copper one seems to be, we're doing a lot of work behind the scenes, but yeah, there's probably a natural progression from gold into copper, but we're monitoring price targets with regard to copper. Gold's got a lot more opportunities here in Australia, and copper obviously opens us up to some global stocks as such. But no, at the moment we're very much focused on this gold fund. I might just circle back just for slightly. People were talking about portfolio percentages. Within the Victor Small Group, for the last 18 months, we've been reducing our equities exposure, and this is the I suppose the dip in regards to making those redemptions or those divestments into other equities and other equity strategies. We've used this as a pivot point to go back into the equities market, and we're upsizing not only at a business level but at a charity level as well as also family. So no, so to answer your question, yeah, we're looking at the other options, but this one fits squarely in what we see as the right investment, the right strategy, the right category for the current times.
Yeah, and I might just add to your comments there, David, that similarly, we at Lucerne have been reducing our equities exposure since about September, October last year, and gold has been a part of that thesis, as well as a couple of other asset classes, to get away from that more broad-based exposure. There's another question here, Cameron. They're starting to come thick and fast now. You mentioned M&A as a catalyst. Which part of the market are you expecting to see that in?
Typically, it is the mid-cap producers that I think there is greatest a chance of that occurring in the M&A space. So, it's an interesting, when I look at the market, if you're producing sort of between 0 to 200,000 ounces a year, you're typically trading on, 0 to 6 times EV to EBITDA sort of multiple. If you're producing maybe 400 to 600,000 ounces a year, you're trading on a sort of 4 times to 8 times EV to EBITDA multiple. And then if you're producing over 600,000 ounces a year, of which there's only Saracen and then the top three that I've spoken about, you typically trade sort of greater than 8 times EV to EBITDA multiple going forward. So there is definitely an incentive, if you like, if you're a mid-cap producer, sort of in that 400 to 600,000 ounces, to bolt on more production, so that you can then potentially achieve that higher EV to EBITDA multiple. So I think that is probably where the M&A is likely to occur, in that mid-cap space. Looking at other bolt-ons for production, but then also the gold space is very fragmented. As I said, 250 ASX listed gold stocks, and the mid-caps will look at the explorers if they think that there is definitely upside and it makes sense for them, and also the smaller producers, and bolting on and hopefully getting that increased valuation.
And just to add on to that, just there, I mean, there was a recent article about 3 weeks ago, and they nominated 6 different targets of M&A, and all those 6 were actually in our portfolio. So we only need 1 or 2 to come home that's just really going to show some good outcomes for us, we think.
Okay. Now the next question I've got here is probably in relation to whether it's M&A or a standalone opportunity, but which mid-cap gold stock could you see being the next to sit alongside the larger ones such as Newcrest, Evolution, Northern Star?
I think Saracen is probably the one that I particularly like. It's sort of producing that 600,000 ounces a year, and as I said earlier, it's in a 50-50 JV with Northern Star for the Kalgoorlie Super Pit. Now, that just to touch on that mine, it's been in foreign ownership for the best part of the last 20 years. And now with Northern Star and Saracen, two very like-minded gold miners, and probably two of the best Australian gold miners, I think, here in Australia. And I think that we're going to see a lot of growth coming from Saracen, predominantly from that Kalgoorlie super pit.
Okay, I've got two more questions, I think, to finish us off. The first one is there a quick way of identifying a penny dreadful without having your deep dive analytical skills, Cameron?
Sorry, was there any identifying any of the penny dreadfuls?
Of identifying a penny dreadful. Somebody's thinking of creating their own gold fund, maybe.
Yeah, look, where do I start? Look, I think there's a couple of key aspects that I look at when I'm thinking about explorers. Firstly is management, and I think that is really key for the explorers. There are a lot of management, or I hate to say it, but maybe some, for want of a better word, maybe some used car salespeople that they can talk a good story, but they probably don't have the history behind them, that they've actually done it. They've actually found gold, and they've actually been able to develop it. So management, I think, is really key for me. And then also, as I say, looking at the ground conditions, putting a geologist's hat on here, the structural understanding of the ground and things like that, I think is also very key. So it's more of a technical viewpoint. But, I think that's, very clear to me. I mean, yeah, that's probably about it. I'll leave it there. There's a lot more I could talk about, but I won't.
Yeah. And how big is the fund presently, Cameron or David?
Dave, do you want to talk about that, or?
Oh, look, we're circling. It's 40 to 50 at the moment. Yes, it's only been to market, and we're getting great response. Obviously, the performance has been very strong, as Cameron said. 30 gross, 24.5% net since to the 31st of July. So that's obviously contributing to the size of the fund as well. So I suppose when we went to market, we were worried about going substantial on the smaller explorers. But the market machinations have shown that there's a lot more activity there, and we don't feel like we're going to get caught in that, I suppose, that substantial shareholder position. So we've got plans to obviously grow it beyond that as well. So
good.
And the only other thing, Cam, that you might want to touch on is just attribution by category, just where we're getting the returns.
Yeah, look, so when we first started, the exploration was definitely a very strong attribution for the fund, performance-wise. As the gold price sort of was going sideways there for a while, the first month or two, but then obviously in July and August, the gold price has really shot up very quickly, and then we're starting to see the producers. The attribution from them really outperform theirs. So, it's been a combination of the two. And I think, again, just underline the point that having exposure to the whole mine life cycle, I think is definitely a benefit and advantage for the fund.
Okay. Thank you. Oh, look, there's one last question that's just popped up, and then we'll leave it there. And that's, are there many mines, do you have sufficient look through, I suppose, on the shareholder registry to see if there are many mines in Australia that are owned by China or Chinese affiliates?
That's a good question. I wouldn't say that there's many mines owned outright by Chinese interests, but there are definitely, on the registers, there are definitely some Chinese interests with exposure to on the registers of a lot of the gold miners, yes. Okay.
All right, we'll leave it there. And again, thank you, David, and thank you, Cameron. Really appreciate your time today. And Lucerne's obviously very pleased to be supporting the fund and appreciate the good work that you're doing and the returns that you've been able to achieve to date. Also like to thank everybody who was able to join us on the call. We will have a transcript of the briefing available, and it will be distributed to those who attended. And if you'd like to invest in the fund, obviously, or know more, then please contact Lucerne, your private wealth advisor at Lucerne. And again, thank you, Cameron, and thank you, David, and thank you, everybody.
Thank you, everyone.